You are listening to Funny Money on the River's Edge Network. I'm your host, Tom Henry, and producing the show tonight is Tom Benoit. How's it going, Tom?
It's going good.
All right. So, Funny Money, if you don't know, it's a show where if you listen to it, you'll get rich, and it's going to be hilarious. So that's the funny part. So, we're going to talk about two different companies. This has been the format of late. So in the retail space, and their names you're familiar with, Best Buy and Target. They're competitors. They're not like exactly direct competitors, but I want to talk to you about them because they both have a competitor in common, and that's Amazon. And, Amazon, the tendency is for everything to go online. Transactions are going more and more online, and that hasn't really slowed down yet. So as long as that continues, it's going to be tough for these two retailers. And can they make it? Are they cheaply valued? Will there be a resurgence in one of these stocks? Best Buy actually has been defying the odds and kind of still posting sales gains even in spite of Amazon taking market share. So, and that's what I want to start out with, talking about Best Buy. All right. Best Buy was founded by Richard M. Sholes. And so I'm going to tell you about him now. Richard Sholes was born, I don't know if it's pronounced Sholes or Schultz. I'm going to say Schultz probably. Schulze. Was born and raised in St. Paul, Minnesota, where he dropped out of Central High School. And then he subsequently went into the Air Force with the Minnesota Air National Guard. So after the Air Force, he got a job as a consumer electronics salesman. This is kind of like the 40-Year-Old Virgin, if you ever saw that. It's like that kind of work environment. All right. In fact, the store in that movie, I believe, is modeled after a Best Buy kind of. All right. So he takes out a second mortgage on his house because he wants to buy his own electronics store, and he uses all of his savings, and so he opens an electronics store in 1966. The store was called Sound of Music, and I guess I'm not sure. Is that like a copyright infringement? Because clearly, I mean, there's a movie called The Sound of Music that would have been very popular at that time. At any rate, okay, the store Sound of Music specialized in high-fidelity stereos in St. Paul. Like St. Paul, Minnesota. St. Paul is like real close to Minneapolis. Okay, it did well, and Sound of Music was able to acquire 2 more stores in 1967. So to say it did well is actually like an understatement. It did really well, and was able to generate enough. So this was a smart guy, working as the electronic salesman. He kind of got an idea or two about how to sell better, or how to manage the store better. A lot of times employees, they think, they could do better than the manager. The manager screws up this and that, and I could do it so much better. And then you put them in the job and they screw it all up. But in this case, here's an employee who thought he could do better and did do better. All right. So the store was doing well, and he was able to acquire 2 more stores just 1 year later. And in 1969, Sound of Music went public on the NASDAQ exchange, even though it only had 3 stores. Now, that's kind of amazing. I've never heard of something that has only 3 stores that was able to go public on the NASDAQ. But I guess this is 1969, so the NASDAQ might have been a little different then. With financing from the IPO, the company expanded, and by 1978, Sound of Music operated 9 stores throughout Minnesota. Okay, so the pace of growth slows down a little bit, but it's still very impressive. In 1981, now this is a very interesting turning point for the whole business. In 1981, the Roseville, Minnesota Sound of Music location, at the time the largest and most profitable Sound of Music store, was hit by a tornado. Okay, now that's kind of random in Minnesota. I didn't know they had that many tornadoes. The store's roof was sheared off and the showroom destroyed, but the storeroom was left intact. In response, Schultz decided to have a tornado sale. That's what he called it, tornado sale, of damaged and excess stock in the mangled store's parking lot. He poured the remainder of his marketing budget into advertising the sale, promising best buys on everything. Sound of Music made more money during that 4-day sale than it did in a typical month. In 1983, with 7 stores and $10 million in annual sales, Schultz renamed Sound of Music to Best Buy Company. All right, so he's thinking, there is definitely something psychologically to this idea that, like, if you have this, this is a limited time only opportunity, to get stuff that's on really deep discount. If you present things like that, like, I worked for this company where we were taught how to do sales, and we were taught that you should get the person thinking that this is your one opportunity to grab things at these discount prices. So we would say, hey, we were just the interior decorators in a house, and we have some excess decoration that we're willing to just like sell at like rock low prices, rock bottom prices, I guess. And would you take any? And it's a total lie, but it was pretty effective. I quit that job. I didn't like doing that. I was like, okay, so the company, so they had 10 million in sales. They renamed to Best Buy. And then the company expanded its product offerings to include home appliances and VCRs in an attempt to expand beyond its core customer base of 15 to 18-year-old males. Because so they were going from like, cool music store type thing to, a broader, bigger electronics store. So later that year, Best Buy opened its first superstore in Burnsville, Minnesota. The Burnsville location featured a high-volume, low-price business model, which was borrowed from Schultz's successful tornado sale back in 1981. In its first year, the Burnsville store outperformed all the other Best Buy stores combined.
Wow.
Yeah. In its first year, that's crazy. In 1987, Best Buy debuted on the New York Stock Exchange. Schultz continued to innovate with company-wide projects called Concept 2 and Concept 3. These were like big movements that changed or refreshed sort of the store layout and kind of the idea that the company was based on. So Concept 2 and Concept 3, and the business flourished, essentially. It's hard, to maintain that, hey, everything's on sale thing when you have like a permanent store. But Best Buy was able to do it. They had a lot of projects, a lot of product turnover. So, there kind of was a limited opportunity at the Burnsville store anyway to get what you wanted. But, once you have a big chain, everything is Best Buy. And, especially in the day of the internet, Now, when you're able to look around and you can see, oh, it isn't the Best Buy, well, then maybe, it's difficult to market with that same intensity. So you have to have different strategies. And I think Concept 2 and Concept 3 helped address that. So the business flourished. Brad Anderson succeeded Schultz as CEO in 2002. And Anderson had worked at Best Buy since 1973 while he was attending seminary school. I guess that didn't work out. So today, Best Buy operates over 1,000 stores throughout North America. Pretty impressive. All right, now the PE is pretty low at 12.69. So the PE being low means that the price compared to the earnings is only 12.69 times. Okay, it's got a nice juicy dividend of 3.23%. Return on invested capital of 13.13%. All right, so that's very good. Everything is good so far. Return on invested capital is better, is a higher percent than the PE, which is a rule of thumb that indicates value. I like to see that, and the dividend is very healthy. Net debt to equity, none. Okay, in fact, they have $2 billion in net cash.
Wow.
All right, and earnings are expected to grow 6%. Which that's no great guns, but I think that the estimate could be low. I also like the fact that they pay high tax and they're domestic. Well, at least they're relegated to North America, and by far the vast majority of their stores are in the United States. So, if there is a tax cut, that would benefit them greatly. So I definitely like this one. It's interesting. And even though it's fighting with Amazon, as I say, it has kept its head above water. And if Best Buy can continue to maintain its niche, I think it will do well. So right here, I do like this stock. It's gone from 26 to 42.14 over the last 3 years. So, and it's a big company. It's almost a $14 billion market cap. So I like it. It's not. You're not going to double your money on it or something, but it's solid. You might get a nice, 15%, 30% gain over the next 12 months. All right, so we're going to take a quick break now, and then I'm going to tell you about the second company, which I already mentioned was Target. All right, see you then.
Hey, this is Matt Geica, your host of Gike's Got Game, 8 a.m. every Friday here on the River's Edge. I'll take a peek behind the sports media curtain, zoom out for the big picture, and as always, obsess over the details of the sports, teams, and players we love or love to hate. It's Gike's Got Game every Friday at 8 a.m. on the River's Edge.
Hey folks, it's Mike Sasson. Just so you guys understand, if there's one thing I do better than anybody I know, it's talk about nothing for an hour. Want proof? Here's the proof. The Mike Sasson Show. It's going to be on from 10 a.m. to 11 every Tuesday starting July 19th. It's an hour that you'll never get back. Neither will I, so we'll have that in common. Here on the River's Edge, a new kind of radio.
All right, welcome back. So the next stock that we're going to talk about, and just to remind you that the first one was Best Buy. The symbol is BBY, and I like it. I think it's a good buy at this level, even though it's competing with the likes of Amazon. All right, there is still something to be said for going to the showroom having salesmen sweet talk people, it still does have a market. So the next one I want to talk to you about is Target, which is quite a bit different. Target has a much wider variety of different products for sale. And usually the store space is larger. It has groceries. So there are reasons, there are things that you can get at Target that you can't get at Amazon, which gives it some inherent resistance to Amazon. But unfortunately for Target, it has not been performing up to snuff recently. And this quarter was bad. So I want to talk about the origins of Target. And it goes back quite a while. It came from this company called the Dayton Hudson Company. And this is the story of the Dayton Hudson Company. All right. The Westminster Presbyterian Church from downtown Minneapolis. Now, so here we are again with like a Minneapolis St. Paul company, all right, which is interesting. Okay, so the Westminster Presbyterian Church from downtown Minneapolis burned down. Oh, by the way, my sources for both of these are both Wikipedia and WSJ.com, which is the Wall Street Journal's website. Okay, so this church burnt down in Minneapolis during the Panic of 1893. The Panic of 1893 was a sharp recession, kind of similar to like 1981/82, if you're familiar with the history of American economics. There was a lot of ups and downs, booms and busts in the late 19th century, because a lot of the rules had not yet been established that sort of prevented those extreme booms and busts from occurring. Although, has it really? They don't occur so frequently. I'll say that. Okay. So without insurance to cover the financial loss, the congregation of the church found itself unable to rebuild. The church appealed to parishioner George Dayton to purchase an empty corner lot adjacent to the original church in its possession. Funds raised from the property sale allowed the church to rebuild, and Dayton constructed a 6-story building in his newly purchased property. All right. Dayton convinced the Reuben Simon Goodfellow Company to move its nearby Goodfellow's department store into the newly erected building in 1902, although its owner retired altogether and sold his interest in the store to Dayton. So he talked this department store owner into moving into his building that he just built and was hoping to get some kind of return on, yet it didn't seem like he had any tenants. And then so they agreed, but then it became, all right, I want to get out of the business, by my company, and then you can move it. And so that's how he started with this company, which is weird. A lot of times, an entrepreneur is like driven from the very beginning, from the childhood. They're super interested in a certain thing, like making gunpowder. And then they, eventually build a gunpowder factory. But then there's also like the random happenstance wanderer sort of, who acquires a company just that wasn't, something that they had targeted, but rather something that fell into their lap. So, okay, so this store was renamed the Dayton Dry Goods Company in 1903, and it was shortened to the Dayton Company in 1910. The company made its first expansion with the acquisition of the Minneapolis-based jeweler J.B. Hudson & Son, right before the Wall Street crash of 1929. So that's probably a terrible time to have made an acquisition because you overpaid for it, because things would have been a lot cheaper after the crash. So Hudson, the jeweler, is the Hudson part of Dayton Hudson. So that's the significance of that. And it's the jewelry store operated in a net loss during the Great Depression. But the department store weathered the economic crisis. Dayton died in 1938 and was succeeded by his son Nelson as the president of the, at the time, $14 million business. Nelson, I'm reading directly from Wikipedia here. Nelson died in 1950 and was replaced by his own son, Donald, who with the companies replaced, the Presbyterian guidelines set by his predecessors with a more secular approach. That was kind of common, for those older companies to have like a religious influence in their founding and the guidelines that they applied. But I guess by the 50s that was pretty retro. Okay, the company acquired the Lippman's department store during the 50s and operated that as a separate division. Okay, so, and you're thinking, well, what does this Dayton Hudson company have to do with Target? Well, it is actually, it is directly Target, just changed its name. John F. Grease developed the concept of the upscale discount retailing while working at the Dayton Company. All right. It's such a weird thing. Upscale discount retailing sounds like contradictory. All right. So using his concepts, the company opened its first Target discount store at 1515 West County Road B in the St. Paul suburb of Roseville, Minnesota. Douglas Dayton was its first president. The name Target originated from publicity director Stuart K. Wittes and was intended to prevent consumers from associating the discount store with the department store. Okay, but why? That doesn't really define why it's called Target. All right, so it's a different name than the department store. That's why they called it Target. All right, so it opened 3 additional units in the first year and reported its first gain in 1965 with sales reaching $39 million. Later that decade, B. Dalton Bookseller was formed as a subsidiary of the Dayton Company. I remember B. Dalton, that went under, I'm pretty sure. Right? You don't see any of those B. Daltons anymore. I think it went under, like in the 2008 crisis. Yeah. Okay, so the parent company acquired the jewelers Shreve and Company, J.E. Caldwell, the Pickwick Bookshops, and electronics and appliances chain Lechmere. All right. So they're buying all these different stores, combining them into one. Obviously, it's going well because they're able to keep acquiring. So now the new store, all right, it had all these different department stores, and it had Target. Target reached $200 million in sales, while Dayton Hudson acquired Team Electronics and the jewelers C.D. Peacock and Jessup & Sons in the 70s. Target reported a decrease in profits in 1972. Okay, that's not that important. All right, so it's saying that there was increased competition in the 70s. And okay, in the 80s and 90s now, Dayton Hudson sold Lippman's to Marshall Fields and expanded into the West Coast market with the purchase and conversion of several FedMart stores in 1982. It sold its jewelers, the Dayton Hudson Jewelers, to Henry Burks and Son of Montreal. So you can see it's paring back, and until it gets to the core Target. Okay, the company founded. The Plums off-price clothing store. I didn't know that. 4 locations in Los Angeles in 1983. The following year, it sold the chain to Ross Stores, and sold the Diamonds and John A. Brown department store to Dillard's. Okay, so Target was established as the dominant retailer in Southern California after purchasing 50 Gemco stores in 1986. Okay, that year, Dayton Hudson sold the B. Dalton bookseller to Barnes & Noble. Okay, all right, so anyway, so Target kept expanding, and that was at the core of Dayton Hudson at this point. That was what they wanted to roll with. So in January 2000, Dayton Hudson was renamed the Target Corporation. Between 75 and 80% of Dayton Hudson's sales and earnings were coming from Target, while the department stores were used to fuel the growth. So they would, generate a consistent amount of profit, and that profit would be reinvested into Target. So that's a good, little model they have. They have what you call a cash cow and then a growth company. They're milking the cash cow, giving the milk to the growth company to grow up. All right. So the company, let's see, what else is significant is that in 2011, Target announced its first ever international expansion into Canada when it purchased the leaseholds for up to 220 stores of the Canadian sale chain Zellers, owned by the Hudson Bay Company. Okay, so Target did open its first Canadian stores in March 2013. So Target is very much mostly in the United States. One of the things I like about it, and that's just like Best Buy, is that, because it pays a very high tax rate in the United States, that any tax cut that we would get from Trump would be very beneficial to the company. Okay, but I don't like the fact that management has had dwindling sales and disappointing earnings for the last few quarters. The PE on the company is 12.25. It's got a nice big dividend, 4.15%. The symbol is TGT, by the way. The return on invested capital, 12.87%. Again, that's higher than the PE slightly, but that's very good indication of value. Now, here's the problem. Net debt to equity, 105%. All right, to me, that's too much. I like it to be about 65% or lower. So 105 is too much, and that's sort of that counteracts some of the goodness of the PE, ROIC, and dividend. Now, this is the other negative thing. The analysts expect sales for 2017 to be down 1%. I mean, earnings for 2017 to be down 1% from 2016. So even the forecasts are expecting, a loss of market share, indicating that to some extent they are losing the battle to Amazon, and but not Best Buy. So I like Best Buy a lot more. Their balance sheet's a lot better, and they've got much better prospects, in my opinion. So although Target is not a bad buy, I prefer Best Buy. So with those words of wisdom, we're going to conclude. So we're all out of funny money, folks, and thanks for listening.